Are you facing the challenge of investing with limited time on your hands? We understand that life can get busy, but today we bring you the solution. In this video, we'll unveil the best investment strategy, passive investments through index funds or ETFs. With this strategy, you can efficiently grow your money and reach your financial goals without sacrificing your time. Don't miss this opportunity to learn how to invest smartly and effectively with index funds and ETFs. What is an ETF? An ETF, or exchange-traded fund, is an investment vehicle that combines the characteristics of stocks and mutual funds. It functions like a mutual fund that trades on the stock exchange, meaning it's bought and sold on the market just like a stock. An ETF is designed to track the performance of an index, commodity, bonds, or other financial assets. By owning an ETF, investors gain exposure to a diversified set of underlying assets without the need to purchase each asset individually. A real-world example of a widely recognized ETF is the SPY. SPY tracks the performance of the S&P 500 index, which comprises the 500 largest companies in the United States. When someone invests in SPY, they are acquiring a diversified basket of stocks from these 500 companies. This ETF is traded on the stock exchange and can be bought or sold throughout the trading day, just like a regular stock. Investors can use SPY to gain instant exposure to the U.S. stock market without having to buy each of the 500 individual stocks that make up the S&P 500. Why is it a good investment? Imagine having the opportunity to hear from two investment giants, Warren Buffett and John Bogle, as they share their perspectives on why ETFs are an excellent investment. Warren Buffett, one of the most successful investors of all time, has praised ETFs for their simplicity and low costs.
This time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
On the other hand, John Bogle, the pioneer of index funds, believed in long-term passive investment through ETFs and index funds as a winning strategy. He understood that most fund managers consistently fail to outperform the market, and ETFs offer a smart way to effortlessly track market performance. In 2007, Buffett bet $1 million that over the course of a decade, a simple S&P 500 index fund would outperform a basket of hand-picked hedge funds. He picked the Vanguard 500 Index Fund Admiral Shares, VFIAX. Hedge fund manager Ted Siege from Protégé Partners accepted the bet and picked 5 funds of funds. A fund of funds is a portfolio of funds that charges 2 layers of management fees. The outcome? Buffett triumphed decisively. Buffett shared the final scorecard of the bet in his 2017 shareholder letter. The S&P 500 index fund he selected delivered a total gain of 125.8% during the decade, while the 5 funds of funds reported respective gains of 21.7%, 42.3%, 87.7%, 2.8%, and 27% during the same period. Buffett gave all proceeds to charity, and Girls Incorporated of Omaha turned out to be the biggest winner of the bet.
Okay, that is, own the stock market and own the bond market. And you can own the stock market through an all-market index fund. You can own the bond market through an all-bond market index fund. And that's the most sensible way to invest. And you have to figure out kind of for yourself, if you're young, you want to be very heavily towards stocks. If you're old and you've got more wealth, less appetite for risk, need income more, you want to tilt heavily to bonds. It's a lifetime asset allocation struggle. And just make sure the funds you buy are low cost. Don't pay sales loads. Watch out for funds that have high turnovers. Index funds do not. Make sure you have very, very low cost operating costs, and zero management cost, which you do in an index fund. And then be careful of tax efficiency, because trading is very expensive. You pay taxes, and devastates long-term investment returns. So it's the bond market and the stock market, and get costs out of the equation. And I guess my final piece of advice would be, don't peak. Just put your money away month after month after month after month, and don't look. And if you start when you're 20 and retire when you're 80, which I'm thinking about doing but haven't decided to do it yet, and you see what that account is worth in 60 years, you aren't going to believe it.
ETFs provide you with the opportunity to invest smartly, even if you have limited time available. So, if you resonate with the idea of simplifying your investments, reducing costs, and achieving long-term results, ETFs are an option you can't afford to miss. Warren Buffett and John Bogle support this strategy, and you can leverage it to build your financial future effectively. Dollar cost averaging, DCA, is an investment strategy endorsed by Warren Buffett for its simple and effective approach in the world of finance. This strategy involves investing a fixed amount of money in financial assets at regular intervals, regardless of their current market price. The fundamental premise of DCA is that by purchasing a consistent amount of assets rather than attempting to time the market, investors can smooth out market fluctuations and reduce the impact of volatility on their investment decisions. Warren Buffett has highlighted this strategy for several reasons. Firstly, DCA eliminates the need to predict market movements, a notoriously difficult and risky task. Timing the market attempts often lead to impulsive and emotional decisions, which usually result in underperformance. DCA, on the other hand, encourages consistent investing over time, aligning perfectly with Buffett's long-term investment philosophy. Another significant advantage of DCA is its ability to mitigate the risk of buying at market highs or lows. By investing at regular intervals, investors buy more shares when prices are low and fewer when they are high, reducing the risk of significant losses in case of unfavorable purchases. This is particularly valuable for investors seeking stability in their portfolios. Moreover, DCA facilitates ongoing investment by allowing investors to schedule regular purchases without the need to constantly monitor the market. This is especially useful for those with busy schedules or those who prefer a more passive approach to their investments. In addition to the aforementioned advantages of dollar cost averaging, DCA, it is essential to emphasize that this strategy significantly benefits from the fact that, over time, the stock market tends to exhibit a bullish and consistent behavior. Historically, stock markets have experienced long-term bullish trends, meaning that, over time, stock indices tend to increase in value. Despite occasional fluctuations and corrections, investors with a long-term view have been rewarded with consistent growth in the value of their investments. By consistently investing in the market over the years, investors can leverage the power of compound interest and the bullish trend of the market, accumulating significant wealth as their investments appreciate. So, why is it the best strategy for investors with limited time available? Simplicity. DCA is a simple strategy. Investors only need to establish a regular investment plan and can automate it. This means there's no need to constantly track the market or make complex decisions. Risk reduction. By purchasing assets at regular intervals, DCA smooths out market fluctuations and reduces the risk of buying at unfavorable times. Long-term focus. DCA aligns investors with a long-term investment mindset, which has historically proven effective in stock markets. Automation. Investors can schedule regular purchases without having to worry about staying up to date with the market. This is particularly useful for busy individuals with other commitments, such as full-time jobs or other responsibilities. Accessibility. Any investor, regardless of their level of experience, can implement DCA. No matter how busy your life is, there are always opportunities to take control of your financial future. We invite you to subscribe to our channel, activate notifications, and join our community of committed investors.